Okay, Walter, just to be cool. Okay, so we're about to get started. Walter, if you're ready.
Yes, I'm here and I'm
Okay,
ready, okay?
great, great. Hi, everybody. Thank you for taking time today to join us. My name is Brent. I'm from SpotGamma, and I have Walter with me. Walter runs Trade to Win and specializes in futures trading, and particularly using the Bookmap trading platform. So I'm gonna cover Market Gamma here briefly, and then we'll have Walter get into the displaying liquidity and how you can trade futures um, around the various levels that we provide with SpotGamma. Interesting day today. I'll just comment. We had that 2950 as a key level due to the amount of open interest there, and we saw quite a slide lower on some. They assigned the reason to some vaccine news, but obviously that liquidity drawdown is how quickly that liquidity sort of disappeared was a little bit concerning, and we seem to actually trace all the way back down to the zero gamma level, which was around 2910 in the futures, and Walter can kind of touch on that briefly. But we really need to hold that 2900 level to keep any type of positive gamma intact. I think if we sort of break that level, you want to be wary of buying dips. I sort of mentioned that in tonight's note. Obviously, from disclosure purposes, I'm not personally registered with any government body here in the United States and cannot offer investment advice. I do offer, obviously, data and research and hope to supply everyone here with that data so that they can make their own investment decisions. So for many of my subscribers and most people on the list are probably fairly familiar with this concept of market signals and options-based market signals. We provide start every day to people, and these are key support and resistance areas, as you know, that are based on open interest in the S&P 500. The S&P SPX options is a very, very large options complex, and market makers use futures to hedge their options position, and that's how this plays into, obviously, as many of you already know, the options signals and options levels for the ES futures. So to touch on very, very quickly, total market gamma, what that means, and then these call and put walls, which are the support and resistance zones. Market gamma, at its core, is the study of volume and liquidity, and that's why we have Walter here to talk about how you can trade and how you can see that liquidity form around key options levels. That's all this boils down to, right? Where are options market makers going to hedge, and where are other options players going to hedge their futures? When they trade those futures, that is what keeps the market around those key strikes. If we only had an options market, you may not see all this movement around these key strikes. It's the fact that we can use futures to hedge these options that keeps things to these various levels that we talk about. So how much options volume will options players produce? This is a note of how big the gamma levels are. And then the second, are they long or short gamma? This tells you how market makers may hedge around various levels, right? So the first one is if we're long gamma, it's going to be a mean reverting type market. We'll cover that. If we're short gamma or we have negative gamma, that means we're going to experience larger directional moves. And then around that, we use these key options levels to put the sort of long gamma or short gamma in context. So what do I mean by a mean reversion or volatility suppression is what we get with positive gamma. This is a chart that many of you are probably familiar with, but the blue space here is the distribution or the forward one-day price distribution. We have positive gamma. You can see it's a very tight distribution, right? And what this means is that we have a mean reverting market. If the market goes up, we anticipate dealers will sell into the market, capping the market move. Conversely, if the market sells off, they'll be buying futures that will bring the market back in. So that produces this lower volatility, tighter price distribution type market. In a negative gamma market, you can see here with the orange distribution, orange bar, you get much wider price movement, right? Because when market is going down, dealers are selling futures, and conversely, when it's going up, they are buying futures, and that expands price volatility. So every day we talk about the SpotGamma index anticipated volatility level. What that is that's our proprietary gamma calculation telling you how much volatility we expect for the next day. And that volatility is an expression of what we think ultimately dealers are going to be doing. Are they going to be buying when the market goes down, or are they going to be selling when the market goes down, and vice versa? One of the interesting, charts when we talk about positive and negative gamma, this is the VIX. If you see green here, that means that we're negative gamma, and if it's red, it means positive gamma. So you can kind of see that there is obviously a very large correlation between elevated levels of volatility and negative gamma, and that is expressed here in this VIX chart, which I think is really a nice way of portraying, what it is that negative gamma is ultimately trying to forecast or tell you as a trader or investor. You have to keep in mind when we talk about volatility, it doesn't necessarily mean that the market is only going down, right? Volatility does not have a direction associated with it. But what ends up happening is to get from a positive gamma or high gamma market to a low gamma market or negative gamma market, we need the market to generally move down. And that is because puts are what supply negative gamma. So typically we'll be above the positive gamma, or you'll see it will be above the zero gamma level. And as you break below or go under that zero gamma level, that's where negative gamma comes in. So the first move to kick in negative gamma is almost always going to be a move lower. And so that's why I think oftentimes people associate the VIX with a negative market movement, right? But really what the VIX is telling you is the initial move is going to be negative, right, to get that VIX to pop. But once VIX is elevated, that is going to tell you, that's forecasting you that price changes going forward are going to be very high, right? There's going to be a lot of volatility. That means prices are moving a lot, both up and down. So I'm just skipping over this because a lot of you that have been invited to this presentation are familiar with my work. This just basically talks about the price bands, and you can read these on your own in terms of what the price bands mean. The video and the presentation will both be available for download, but in the interest of time, I'm going to skip forward a few of these slides just so you can check this out. This is our updated history of the bands backtest. So the green line is sort of what we call our call wall or high gamma strike. The gray line is the put wall, and then we have this red line, which is the zero gamma level. What I really want to touch on with this is you can see that in this green zone here, which is to the right of the chart, there's a lot of volatility or noise in that call wall signal, right? And that is because once February fell apart, call positioning has been very, very light. And so what's happening is, in the models, picking up very frequent changes in the call wall or where positive gamma is located. And that is one of the problems with the market finding stability here, is that call positioning is very light. And that's sort of what the noise, again, in this green signal here to the right of the chart is telling you. There's just a lot of put activity, and there's a lot of hedging around puts, but there's very little call activity, and that is what supplies positive gamma. That's what stabilizes the market. And when you see these indicators, this green call wall or high gamma strike indicator moving around a lot, that is an expression of the fact that we have very low levels of positive gamma in the market, and that's a little bit concerning if you're looking for price stability. So we want to talk quickly about put walls and crash protection. This plays into the whole concept in general. Puts are obviously how most people will hedge against market sell-offs. And puts are very obviously sensitive to both time decay and implied volatility. And so when you think about how people are hedging and what you have to do with puts, you have to actively trade puts. If the market starts to crash and implied volatility really spikes, as many of you know, your put will be extremely sensitive to the movement of volatility, and you may not want to hold that put to expiration, because if you hold it to expiration, implied volatility may come down, and that may really reduce the value of your put. So you are behooved as an investor or as a trader to monetize your puts, right? To roll them out or close them and be very active with your trading. And I think that is a lot of what brings volatility to the market. When the market is dropping hard and investors are active with their put trading, that is an obligation on the market maker to adjust their hedges. And so in March, we had a whole lot of very deep in the money puts, and there was a lot of delta hedging, a lot of futures trading associated with that from market makers. And if you think about, conversely, when people are trading calls are less sensitive to implied volatility. People are more likely to hold them to expiration. I want to stay long these calls. There's a little bit less decay, right, because they're not as sensitive to implied volatility. And also, when the market's going up, implied volatility is not usually doing that much. So you're more likely to hold a call for a while or be more comfortable maybe with the risk associated with the call than you are in puts when the market's really crashing, implied vol is going through the roof, and you need to be more active. If you just think about that concept, I think that is a lot of what is driving volatility, right? Are there a lot of puts in the market? Are they deep in the money? Is there a lot of trading associated with that? And if so, that is what's creating a lot of that volatility, right? If we're drifting higher and vol is lower and people have long calls, well, they'll hold those calls and they'll be less likely to actively trade those positions. So, we talked about puts. This chart is just showing you sort of this idea of the gamma cycle, right? And so this chart is from last year, but what it shows is that there's a cycle when you close puts, right? If I'm long puts and I close those long puts, the dealers who are short puts have to be hedged with short futures. So if I close my put, that means that a dealer's bought back the put, he's now short too many futures, and he needs to buy back those futures, right? And buy back those short futures, and that can create a lot of this V movement. And I think that's a lot of the V movements we see playing out now is this cycle of, okay, a bunch of long puts get closed or expire, as what just happened in, on Friday with the May expiration. That drives dealers to have to buy back a bunch of futures, and then we kind of enter this sort of regime of, of a repetitive cycle of this, puts being monetized, and that ultimately drives the market higher. So that's why we like to pay attention to the put wall and where that concentration of puts are, so that we know when this sort of buyback, I call it the buyback cycle, because again, I close my long puts, that means dealers need to close their short hedges. We've shown this chart many times. All of you can look at it. It's an example of how we sort of play off the zero gamma levels in the futures. Walter, in a minute, will be touching on that, so I'll skip forward over this. Same thing with this a view of the Iran bombing and an overnight move there in futures. And so if you're interested in the SpotGamma research, these are the levels that we provide every day. And for subscribers, I know that you see this email every day. All of these levels that you see here are imported into the Bookmap trading software. We're working on the ability to import into other futures platforms as well. And this is not a Bookmap specific presentation, but Bookmap does an excellent job of displaying liquidity, and Walter's going to touch on this and show it, and that's why I think it's such a valuable tool. But all of these levels are imported into Bookmap, and what we're going to be showing you today is how liquidity forms around many of these key levels that that we produce for subscribers. This is an example, this is the February example. Again, many of you have seen this before. It's on the homepage of our website. But when we break zero gamma, this is ultimately what happened in the February crash or the February drawdown. Again, most of you are probably familiar with this. We'll be taking questions afterwards, and you can always email me if you want to dig into this. But in the interest of time, I'm going to step forward over this slide as well. So one of the big things we're going to be talking about today are absolute gamma levels. And what we're doing here is we're looking at the open interest in the S&P 500. We're aggregating every single strike in all expirations to figure out where the largest, not just open interest, but where the largest gamma pockets are. And there's a key difference here. If we just look at open interest may be largest in a strike that is way, very far out of the money, right? The largest put position in terms of open interest may be at the 2,000 strike in the S&P. That's irrelevant to where we're trading today, right? So when we weight the contract by gamma, you get the chart that you're seeing here. Gamma is largest for near-term expiration and also at-the-money options. So when we weight it by gamma, it's really starting to sort of, I say, put some meat on the open interest, right? It's telling you where the relevant open interest is. And we expect these areas to be large, to have large levels of liquidity and or active areas of trading, as Walter's going to touch on in a minute. So in this case, obviously, we had here's the 2,900 strike. This chart is from a couple of days ago. It's relevant today. 2,900 strike has a lot of gamma. We expect that to be a support or resistance area because as the market gets near this strike, there's a lot of trading activity associated with this level. And then obviously as you move down, there's other strikes that have large areas of interest. So if we're going to set a trading plan for today, and what you see in Bookmap is the 2,900 level, 2,925 and 2,950 would show up as key gamma levels and key areas of interest for you as a trader, be it futures or options. These are strikes that you want to pay attention to. So just to give you a quick example, this is the Bookmap platform, as Walter's going to be touching on. But this is a very interesting overlay that will show you as an introduction into Walter and his piece of presentation of how we will see these key levels that I produce mapped in Bookmap and how they may show up in the futures trades for the day. So here you can see in the white block in the center of the chart the key levels that we put out for the day. So you have your absolute gamma level, which is this chart here. This is the largest absolute gamma level. So in this case, it was 2,800 for the day. High gamma strike is where the most positive call positioning is. And then we have the zero gamma, which is where gamma flips from positive to negative, and you can see how liquidity shows up and the market reacts to all these various prices. So these levels here on the spot gamma column, which is all the way to the right of the gray screen, are the imported levels. So there's a CSV file that can be imported into Bookmap, which shows you all of the various levels that SpotGamma here sees as important to note on the trading day. And we see many, many instances of how liquidity forms and shows up around these various levels. And that is what my friend Walter is here to talk about. Again, Walter's from Trade to Win. And he is now going to show you, using Bookmap, how these levels play out, how one might perceive the liquidity that shows up in the futures market that are related to the SpotGamma levels. Walter, if you're ready, you want to take the screen share and show your screen or whatever may be best for you there?
Thank you, Brent. Can you hear me?
Sure. I can, yes.
So hello, good afternoon and good evening, ladies and gentlemen. Welcome to our presentation. Thank you, Brent. And what I would like to do is now to show, based on Bookmap, how SpotGamma and Bookmap works fantastically and fantastically together. Allow me first to say that trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Webinar and documentation are intended for educational purposes only. Let's connect Brent's presentation with the visualization trading platform Bookmap. You will see that both worlds ties perfectly together. The primary intention of trading is, of course, as you know, is to making money. And I want to show you that Bookmap is telling every trader in real time what a liquid market is doing and what it intends to do. And SpotGamma levels indicate possible turning points combined with liquidity in Bookmap. That's absolutely exciting, as you will see in a few minutes. A few words about Bookmap for those of you who are not familiar with this platform. Allow me to spend 5 minutes just to give a very brief overview about Bookmap. Conceptually, Bookmap is built from the ground up to be an order book and order flow visualization tool. It is the best trading software which is able to simplify an overwhelming amount of data for the trader. The main difference between Bookmap and other trading platforms is that other platforms simply add sort of heat map to an existing DOM. So let's go briefly through different parts of Bookmap. The screenshot you see is how I'm utilizing Bookmap in my daily trading to find where, when, and why to execute trades. I'm posting this the similar screenshots every day on Twitter as well in my trading room. So let's start with the historical data part of Bookmap. This part here. I hope you can see that where my cursor is. This is the historical data part of Bookmap. Along the trading data, historical visualization part of Bookmap shows the how I call it communication between the trader market, between the traded market, me. So the market is telling me every day and every minute, every second what he intends to do or what the market intends to do. You will see liquidity. We'll talk about that a little bit later. Flashing, staying, and driving the price up and down. You literally can see which side of the market is dominating. The bid or ask side, that means sellers or buyers or sellers in this case. You can watch spoofing in real time when it happens. You can see stop runs. You can see icebergs. You can see visually what volume is traded, because it is represented here by this volume dots, as you can see on this screenshot on this slide here. The bigger the dots, the bigger the volume. The smaller the dots, the smaller the volume, or traded volume. Yeah, that's the traded volume, market volume here. That's what I mean when I'm saying the market is communicating or is speaking to you and speaking to me. Most of us are simply not used to see the markets that way, and that might be a little bit strange for some of you. I'm not sure, but therefore I'm trying to show you what Bookmap offers. Actually, trade area is where you see the actual trades. That's here, this one here. So that means that's the execution on best bid, and that's the execution on best offer. Even you can see if you're trading stocks, the spreads for the stocks being traded here on this actual trades area. I'm totally fan. I'm absolute big fan of the limit order book, which you can see here in the right column of Bookmap. The limit order book gives me valuable and necessary information along the trading day. It is organized like a normal DOM, as you might know. So that's the limit bid side here, which represents the buyers, and that's the limit ask side, which represents the sellers. Between those columns you have the market orders, that means aggressors, and I have arranged, besides the bid and the ask side, the quotes delta. That means I can see, or if you arrange it the same way, you can see pulling and stacking of orders. That means it gives you a clue which side is pushing and which side is pulling on this side. That's a complete limit order book which inherits and gives you really important information during the trading day for your traded instrument. I've added the volume profile that's based on the daily data. I have also the point of control as well, the VWAP in my chart, so that I have the most important data and the most important indicators for the actual trading day, for the actual traded market, for the actual traded data. Nothing is average. Nothing is smoothed. That means we are talking here about real-time data, real-time presentation in the book. So below, the indicator panels are organized, or it's organized. That means what I'm showing here, this is the proprietary TTW-MarketVolumePro indicator. All indicators you will see in the indicator panel below the chart, below the historical data and the actual trades charts of Bookmap, as well as the widget panel, which shows the numbers of and the visualization, the depiction of the indicator, if you have some. So you see traded volume here on the hit bid, on lift ask, for example, and the delta, the volume delta for this at this moment when the market trades at that moment. That's the depiction and the presentation of the volume here. When it comes to additional and needed information, and then I'm coming to SpotGamma here, Bookmap offers notes columns, which means you can add your own labels, you can add your own levels to it, you can connect the levels with an alert, for example. SpotGamma levels are coming into this, also into this cloud notes. That means this is simply a text column which has all the information Brand is updating daily or every day. You can see that here in this column, and you can then mark them with a line, or even you can add an alert to these levels here in the cloud notes.
Right, and real quick, Walter, those are updated every day, and what we do is we adjust them by the difference between the SPX and the front month contract. So I'm adjusting by about 6 points right now. So if the level is 29.50 in the SPX, you'll see the level will be a little bit closer to 29.44 in futures.
Great. Yes. Thank you, Brent. So that's a very brief overview and maybe answers the question, what is Bookmap? If you are curious and want more to know, you can visit my webpage and as well Bookmap's webpage. There are a lot of YouTube videos around Bookmap, how to set up and what it is. So you can get more information there. Additional, before I'm coming back to SpotGamma, just a few functionalities for those of you who are maybe new to this kind of data presentation is the functionalities of Bookmap is mainly record, replay, and run simulations. That's, from my point of view, I think the golden bullet for Bookmap, because it helps you to record every day, and then when you have time, go back and replay your market. It helps you. It helps to understand and to see really the hidden the secrets of the market much better than any candle chart I know, and I did it all. So candles, footprints, volume profiles, whatever whatever you're thinking about, I got them all and I tested them all. So give Bookmap a chance if you want to understand really deeply what the market is doing. You can also see the real market spread. You can replay the market, live HD videos up to 125 updates per second. You can zoom into the highest resolution. That means it doesn't matter how complex the market is, you can see literally every single traded contract at a certain price and at a certain time. You can trade, of course, directly off the chart. You can also do cross-instrument trading, that means watching ES and trading the micro. You can also watch your orders on the chart and replay them. You can connect your own data or proprietary indicators, what we did here with the TTW-MarketVolumePro indicator, which is solely responsible to display the aggressor volume. Indicators panel are, of course, synced to the chart, and you can develop your own API and automated strategies. So that should it be that completes Bookmap and a brief overview of what we are talking, what Brent and I are talking about, just to give you an idea about. In my live seminars as well, online seminars, I'm talking about correlations and how important they are. I'm firmly convinced that nothing works in isolation, even not markets. If this is true, then we must have a broader look if we want to be and if we want to stay profitable in our trading. Given you are trading ES futures, then the ES future is only the base where you hope to make money with. Did you consider to look for positively and negatively correlated market for ES? Positively correlated markets are, for example, the SPY. Negatively correlated markets is, for example, the Volatility Index, the VIX. Negatively correlated markets, is also or was up to February this year, US dollar yen correlations. It worked fantastic last year, as well as the treasuries did. Everything is tightened together. Coming back to options and SpotGamma, that what Brent said, the multi-billion influential industry out there are the hedge funds. They need to hedge, and dependent on their position, they must buy back shares of futures or they must sell shares of futures. That's what Brent mentioned a few minutes before. And I'm sure we can guarantee you that they are not trading 1, 2, 5, or 10 contracts, future contracts, to make money. They are moving millions and millions. And by saying that, they act according to mathematical programs to hedge. We have influence on the traded market, on the ES, on the NQ, on the YM, the treasuries as well. The currencies and oil based on the US dollar, for example, there are a lot of dependencies which we should take into consideration when we start to trade. As a conclusion, we can't miss, from my point of view, what SpotGamma is offering here. We get an insight of option traders directly in Bookmap's chart. We understand the influence of option market makers, and that gives us an edge in trading. So when we get a complete picture about our trading market. The edge in trading starts with the liquidity concept of the market, and here I would like to spend a few minutes on this liquidity concept, as Brent mentioned before. I need a little bit to explain the liquidity concept in order to show then later how SpotGamma and Bookmap are tied together. As a Bookmap user, we are interested to see where possible market turning points are. One of the concepts we have is to use liquidity as our guidance. What I'm teaching and presenting is that liquidity is divided in 3 categories, or better, yes, if you want to call it priorities. So we are talking about long-term high liquidity, we are talking about short-term high liquidity, and even about very short-term liquidity, which is mainly used when you zoom in for spoofing and driving market within seconds in a certain direction. It is helpful because you know when you see spoofing, even it's very, very short time, extremely short, maybe 1-2 seconds or few seconds, you will understand what the market makers are intending to do. Well, what's their intentions? They need maybe cheaper price to buy, to start buying, and so on. On this chart, you see very well I don't want to talk about this very ultra short term liquidity here, but let's just speak about the long-term high liquidity and the short-term high liquidity. According to the Bookmap here, the limit order book you see on my right side here, it gives me very valuable information about the market and the market intentions, what the market is trying to do. You see here at the price of 29.45 and a quarter, 546 contracts sitting on the limit ask side. That means this is these are resting orders. And you see in this picture here, it started, I think it started long before the market opened, and at 9:30 Eastern time, 9:30 a.m. Eastern time here. That means this is a long-term high liquidity sitting there with a certain intention. There's a certain intention. These guys who are adding to this level here has a certain idea, certain trading intention, whatever they have. We don't know really the motivation for this volume here, but it's there. We should notice that, we should obey that. We can't ignore that. On the other side, we have short-term high liquidity. Excuse me, the long-term high liquidity is represented by this, in this case, in this picture, by this red, orange, and sometimes very, very red, dark red areas, which means this is a high traded area around 29.40, not at 29.40 level here. It was a repellent for the price here, for the volume, traded volume here. The market maker at that point wanted to trade lower in order to buy back here their positions, maybe to buy back, to start to buy the positions, to add to their positions here at that price, 27. So we are also talking about short-term high liquidity, which is only a short time in the book. And you will see that along the day, that's absolutely important because the short-term high liquidity is responsible for driving the price into a certain level, into a certain price level. It's only there for 1, 2, 3, 4, 5 minutes maybe, and then they cancel it. I mean, what you don't see here is as well important as what you see here at 29.35 level, 29.34 level. Here in that area, you see that the market maker actively canceled the liquidity here at that point. You maybe also notice or see this a little bit sharp line here, which divides this bright blue versus this dark blue area here. So they canceled. That means this is the canceling of contracts is an active process in the market. That's nothing which is done by chance. It's an active process, as well as the adding liquidity or stacking liquidity to protect a price level, to resist a price level, or to support a price level. So you see two things here: the short-term high liquidity, which is clear and visible here, but you see also that they cancel actively here the volume. And I'm talking about when I'm tweeting or when I'm talking about this liquidity or in my trading room or on the tweets, I'm talking about the business is done here, and at this point here, the business is done. So the market makers did what they wanted, and then they canceled, they stepped off of this levels here. The dynamic of liquidity can be understood. There is no doubt about it. It takes time. Though for a beginner there will be a lot of questions. For example, when is liquidity reliable? Which level of liquidity is reliable? What are the differences between resting liquidity in the book? All those questions comes up very fast when we are talking about liquidity, and be sure there are answers. There are quite good answers to these questions. Liquidity is a key concept, and I'm teaching and discussing this concept thoroughly in my seminars because they are extremely important to understand what the market is doing and where the market is heading to. To keep up with the direction of the market and to trade in the right direction. That's what we want. We want to be on the right side of the market and making money. Okay. And additionally, we are interested to see where and how the ES future market reacts on different levels based on the liquidity and SpotGamma levels. That's where SpotGamma comes in, and as Brent mentioned, it provides a service which is extremely valuable that tracks the XPX options data and provides these key levels for Bookmap. This key SPX levels often comes together with important ES liquidity areas, as mentioned before, and it's still, I want to stress this because sometimes you will, not sometimes, but very, very often you will see that the SpotGamma levels comes together with liquidity levels. And at these levels you will get a good understanding what the market intends to do. The value is that volume visualization makes it easier to understand the activities of passive and active traders, and that opens a completely new view and understanding in trading liquid markets. Adding it to your chart, you get instantly an idea about the possible levels and market intentions for the day. It shows support and resistance areas, like here. That was the screenshot of last Thursday, the 15th of May, and it was a great trading day because you see here the SpotGamma levels, and when you squeeze the chart, you see these levels before the open. We are not discussing hindsight here in this case, yes, but the levels are before they open in the chart, and these levels are relevant key support and resistant levels. As mentioned before, liquidity and its understanding is key to understand and interpret SpotGamma best. Based on this knowledge and SpotGamma information, you have several trading opportunities. So as a future trader, you can, based on this example here, you can scalp or play swing trades, for example. You know what happens here. You see the volatility trigger, you see the zero gamma here, you see how the market hits this level again. In this case, we don't see the liquidity very well because this is a zoomed chart. We will see that in a moment on the replay.
And Walter, just to interrupt real quickly. So on this chart, there's three of our options levels there on the right, on the left side there, right? We have three white lines and three levels that we're really looking at on this chart. Is that right?
Yes, we have zero gamma,
okay,
the volatility trigger, and the SPX level at 2850.
Okay, thanks. Just want to clarify that.
Yes. Oh, I'm sorry for that. Yes.
No,
so
no problem.
Yeah, we have zero gamma level here. We have the volatility trigger here at 2850. If I see that right, 2855 was the zero gamma level, and the SPX level was 2850. It's up around 2844. That's what Brent mentioned before, that they adjusted to the future, to the yes future. And what I wanted to say now, you see the advantage of this system. So given you're a future trader, you can scalp or play swing trades, whatever you want. And as well as an option trader, you can, excuse me, as an option trader, you can, you can sell calls or buy puts or sell puts around this level, whatever, yes, around these levels. Whatever, there's a bunch of strategies, I'm sure a bunch of strategies how to play these levels as an option trader too. So it gives you, it satisfies both both worlds, the future traders as well the option traders. Or you can combine, if you are a future and option trader, you can use this information because it shows you, and that's one of my most important points, to understand where to trade and when to trade. Time is an extremely important indicator. Every day, that means to time your trades. And the most important part of the executing a trade is to understand and to justify for yourself, is to say why to trade that. What is the reason to take a short trade here? The key is that market maker and options volume hedging, it ties to these various levels, as you can see, to the zero gamma, to the volatility trigger, as well as to the SPX levels here. So it gives you an absolute advantage before the market starts to trade, to have an overview, to have a brief overview about the market and to see what is in today, what could be an important level for myself, for my trading. And when you put in context liquidity, when you put in context, for example, the indications here like stop runs, when you put in context maybe divergences and deltas, you get many valuable informations what the market is doing here, right here. We have had an absolute interesting day today, and I recorded it. I would like to talk with Brent about today's market. Yes, that's today's recording. It's May the 19th, 2020. So we have we have some interesting movements in the market when I'm zoom in into the chart. First of all, I'm talking here about the SpotGamma levels. We have still this SPX levels in 29.50, which comes together with 29. I'm reading 44 here, 44, 45 level here. What I'm doing is when I've got this level, I have my only daily levels here, so I'm just squeezing the chart and see, I don't know whether I can see all levels here. Yes, I see all levels SpotGamma and Brent is providing to us, and have a very, very good idea what is open interests has the most volume, and where the zero gamma is and where the volatility trigger is. That gives me a clue what the market might play today. It's not every day is like last Thursday, for example, where we get so clear, crystal clear signals of the SpotGamma and what the market's trading around these levels, for example. So what you see on my chart here on the left side, the very left side here are my daily levels here. And these gamma levels are coming in as cloud nodes from Brent, and they are, as mentioned before the open on your chart, so that I can finally adjust and draw in my lines here to stay alerted, or to see what the market is doing then. What happens today is it was absolutely remarkable to see that the market was trading all the time around this 29 was it? 29.45, 29.44 level. Just give me a second. Yes, yesterday as well. So sorry. Can you repeat it? I can't hear you, Brent.
That level was key sort of yesterday as well. I mean, we had a much larger rally to get to that same area of 29.50 in the SPX and 29.40 in futures, and that level again showed up today. It was a similar move pre-market where we were at 29.70 overnight and then 29.30 pre-open in futures, and somehow we sort of settled into that same range again, right around that 29.50 SPX strike.
Yes, and when we zoom in, let me brief just to give you an overview. Then I would like to try to zoom in and show you what happens at that levels. As we have a rotation, the first rotation here into this 29.45 level, then they broke up, and you can see that as a resistance at support level. So if it breaks above, it is first of all is first of all support level. If it breaks down, it is a normally resistant level. Then we have, I don't know what happened here because I was.
There was news about a vaccine trial that didn't go well, which is the excuse for.
Okay, good. So. But up to this point, we see that this level acted famously, and we're very excited for this level here. Let's zoom in. Let's try to zoom in here into this level here to see better what happened here. Yes. No, we don't see any. We see liquidity here at that point, and they break out of the liquidity to 56 level, and they're coming back. Excuse me, I have to switch off this one here. They can trade it back and forth. Yeah, the liquidity came up, it was broken, and then traded directly into this 44 area. What the TTW-MarketVolumePro is showing you is, for example, stop runs. You can very clear see where the stop runs or sweeps happens, and they happened in this 29.44 to 45 level without any without significant liquidity around here. The liquidity was at 45 level here, and it was broken for 1-2 points here. That's all. That's normal, usual, because if you understand sweeps and if you understand stop runs, which are algo driven, they are a little bit more brutal at some points. So they are going through this liquidity like nothing, and they are then swinging back. That's the point. What we should obey and should have a look at the stop runs here, and this indicator is helping you to understand where the stop runs comes in and what they are, how to trade them. Good. Let's have a look. After this, we are still at 29.50 is still our support here, and what we have here is a sweep down. Maybe this was also point because I don't know what happens here. This was in news. You see very clearly the liquidities was on the 29.55 all the time, and you need, in order to break this liquidity, you need enough buyers to lift the offer. You have to go through this ceiling, you have to break the ceiling, you have to have enough buyers to go through this and to break this levels to lift the offer. We saw that yesterday, I think it was this phenomenal panic buying day where every part of liquidity was taken. So we have had a long day yesterday, and every part of liquidity was taken by the buyers. In this case, we have to watch the correlated markets and see what the VIX is doing, what the SPY is doing, for example. And we should also have to understand the market direction better, the market indicators like ADDs, for example, NYSE issues, and so on. Okay, coming back to SpotGamma, what was interesting there, they're traded around this level all the time. I don't know, Brent, I don't have any good explanation for that, but liquidity was there. They tried to protect here. Let me show that again. Excuse me.
Yeah, the general idea here would be when you have an area of large open interest, you're getting a lot of trading activity, both calls and puts around that level. And so it becomes a natural, I like to call it a volume node, but basically you're getting hedging tied to that level on a short-term basis, right? So that's why you may see the market couldn't really pull away from that strike earlier in the day. That's why the market went straight to that level yesterday and kind of died out even after a large rally. And that's after the first breakdown here. It took a little bit of a longer time frame, but we eventually returned again to that strike. And I think the reason that is because you get this consistent, constant hedging that is tied to that level. Now, at some point, that hedging dies out, be it that orders are filled or risk is off, or it's also possible that just enough puts came into the market, or that sellers eventually just overwhelm the hedging activity. But you'll see that the price will come up and will mean the market will mean revert around this price. So if you look at that white line across is the key strike that we note, and you'll see that liquidity or the market return to that sort of liquidity node or center quite often. It keeps checking back into that level.
Yeah. Just coming back to our presentation here, Brent, yes, I would like to add this one. You see how liquidity fits in and comes into this 29.44 level here, 29.45 level, this open interest level here. This is a volume node, and they tried to protect or was how to say, to repel the price from this level here.
And the thing too, I want to note that I find interesting is we're adjusting the SPX price to the futures level, right? So the liquidity 29.44 is a little bit of a weird place you would think for it to for liquidity to show up, right? It's not a round number or something along those lines. If what I'm saying makes sense. So what that is telling me is that the players that are active at this level are tied to a 28.50 strike in the S&P, right? That is one of my signals that it may be the market making or options related volume, because again, 29.44 is a little bit of a strange strike for the market to sort of revolve around.
Yeah,
that makes sense.
Yeah, thank you, Brent. But anyway, they added liquidity to 45, 44, 45 level here. You see that. And what's interesting is that the first attempt was to drive market, to drive the price lower. And you see this, how to say, what it says, this break or this hole here. That means the business was done for. At that point, the business was done for the market makers, and when they see that the price is coming back, that they're buying spikes, not on the volume was quite low at that point here. They are added liquidity again around this level. They added liquidity again, and then suddenly, and that's what makes the trading so exciting and sometimes not predictable. This is a stop run, a buy stop run or a sweep into this 54 area. I think they wanted to catch some stops here, and then that was, I think that was the final move up to fool the people.
Right.
To fool the people. You can't do anything against these stop runs. They are algo driven. They are based on external events, news, tweets, whatever. It's not possible. You see how liquidity disappears immediately around this stop runs here. I think from my experience, this was really a buy stop run to catch all stops here. And when you catch all stops, it goes in the opposite direction. Yes, it's exactly. Now they're traded around this 25 level again. You see how liquidity is coming up around this around the levels here. It's not quite exact to the tick, but you see what they are doing, what they did before here at this level, and then this stop run happens, this buy stop run. So their stops are hit, and they must be executed market immediately. That means the price is coming down, and they are trading around for, let me say, 10 minutes, around 10 minutes at this level again, maybe with the hopes to save what they can save and to keep the price around this open interest level. And then the last point, they broke down. There was no hope for the market to keep the price or to keep the close into this 29.44. So I don't know what the market is doing right now, but it doesn't matter because I stopped the recordings here to be for the.
We're down around 29.10 in futures.
Okay.
Last time I checked, 115, okay. which is actually the zero gamma level in this case.
Yes, I think the zero gamma level was or is. Let me just have a look here. When you look here on my screen here, zero gamma level is about 29.07.
We're down in that area, in that neighborhood now. And so to this point, I think one of my philosophies around these levels is that the open interest comes out every night, and so at the very first set when trading opens in the morning is when the gamma data is cleanest, right? Because we know where most people are positioned, and there has been no volume taking place for the day. So what I mean by that is that we know where basically everyone's positioned at 9:30 in the morning. And then as the day goes on, people are buying and selling contracts, news is coming up, levels are adjusting, things are moving around so that by the end of the day, the signal starts to deteriorate a little bit. And so if it's not a big level, you will see that oftentimes the liquidity will go to that level in the morning, and then by the end of the day, the market will drift and other things will happen. So that's kind of one thing to note, that the open interest for today is important, but also is there large volume in the SPX at a specific strike? So today's options volume in the SPX was very light, but if we saw a very heavy volume in 28.50, I would be willing to bet that the market would have held on to that 29.50 level today, right? Because when you have active volume today, that is another force to keep the market to a specific strike. And the last point, which is related sort of to the breakdown that we see here, is that I don't think that market makers are hedging all day. I think they have to hedge when there's a large sharp move or when there's a large trade that comes into the market. I think that the most important point for their hedging is into the close. So a lot of times we see what I like to joke about and call it the power hour, which is the last 10 minutes of the day, that you'll see very sharp moves. And the reason, or one of the reasons, obviously there could be many factors, but one of the reasons is that the market makers need to go home risk neutral or have a set amount of risk at the end of the day. And so their sheets, their risk profile is going to be set at the close of trading. They are going to have a clearing firm or risk managers looking at their sheets, their runs, looking at their risk and saying, hey, why are you short so many deltas? Why do you have so much exposure here? They don't want to have that happen, right? Because again, 4 o'clock New York time, the cash close, 4:15, the futures close. That is when the risk is snapped for the overnight. So they need to be, they need to have their risk squared away by the close. And so that's why oftentimes you see these big futures moves, right? Because they don't want to transact all day. They just want to make sure that their book is squared away to go home at night. And so I think that's a lot of times why you see these big sharp moves and changes in the day. I will also often mention, and this is again related, sorry to sort of take over here, Walter, but you can watch the VIX as a way of monitoring which way that end of day move might happen, right? If you have a VIX that is going down and dropping, that means that puts are losing value. If you believe that dealers are short puts, they are hedged with short futures. If the VIX is going down, that means those short puts that they have made them money. And that means that they are too short of futures and may need to buy into the close. And you can correlate these things. You can see, the market will move up quite sharply into the close. Conversely, if you have a higher VIX, that may mean that they need to sell some futures to re-hedge themselves. So you can sort of start to take and put all these pieces together and sort of see that and watch that play out in the map that Walter's showing here.
Absolutely. Thank you for that. What I'm still obeying and watching at when I have this level. So I'm watching this 25 level here, 29.50 level. I see the volume here at it acts as an resistance at that level, and then if it breaks if it breaks really hard that level, then what Brent mentioned, I'm looking for the next levels, 2907, 2908, maybe as a possible target. Maybe not even up until the close, but maybe after the close, or maybe until tomorrow, or in the night sessions as well. So you can consider that as well as targets if you are looking and try to see the market as on a holistic view. By the way, I'm trading here. I have as Rhythmic as and the DX feed as well. You can see that here, and I recommend, if you have the chance, whatever broker and data feed you have, I recommend the XFIT and Rhythmic because they are delivering high quality data called market by order data. So I have the VIX and this is the ETF and the VIX future here. So what I see is extremely well what the VIX is doing, and then putting it on a second screen, and I can see very well and following simply this direction of the VIX and seeing the sell-off in the S&P.
Quite correlated. Huh?
Yeah. So that's correlations makes sense for nearly every instrument, nearly every liquid instrument you have. So I would like to stop that, because it gives you an excellent, even if I didn't expect that, to be honest, for today. Excuse me. It gives us an excellent view on today's market around the SpotGamma levels. I'm absolutely excited, even if it even if it took, I don't know, hours. It happened, yes, in the last 1 hour of the trading day. Even if it happened after a few hours of boring and watching and this levels here, it was exciting to see how this levels comes tied in during today's trading, and that everyone who is watching, understanding what is really displayed here in the order book on Bookmap, could have had a nice close into this day of about, what you said, 20, yes, maybe 20 points. That's a great outcome. That's a great profit. Okay.
Yeah, and to that note, Walter, one thing I'd like to mention is we have this the SG index, which is our gamma index, and one of the things that we do is we produce how much volatility we expect to see based on that index number. So if we take a given gamma number for today, we can look at historically how much the market moves given this level of gamma. And we have enough data points now that we can create some forecasts around 1 day volatility or 5 day volatility. So quite interesting. Yesterday, the forecast was for, I believe it was 2.5 or 3% of volatility, and that just means movement in the market. And today we got a 1% forecast. So we look at where the gamma was yesterday and then can forecast today's note. And yesterday, obviously, we had a 3% move, so it was a very high volatility day. And today, the forecast was for a 1% move, and we had exactly a 1% move. And so that's another thing to consider in the levels when you're mapping out your ranges for the day. If you look at that expected move, and again, that's in the daily emails, you can then sort of map out a plan and say, hey, given that the anticipated move for today, or one standard deviation move, is, let's say, 1%, that lines up with the 2950 high open interest strike. That may be a good target for me to sell or to short. If that makes sense to everybody.
Absolutely. Great.
And so I'm sorry, Walter, real quick too.
Yeah.
We've opened up the chat. You can enter in questions, and Walter and I will be more than happy to take those questions if you want to start entering them now. And sorry, Walter, I won't interrupt you again.
That's okay. Just want to show you only 2 slides before I'm finishing here. Is you can add SpotGamma levels into Bookmap very, very easy. It's a straightforward stuff here. Nothing to work around to what needs a really, really long time. It's only maybe a few seconds, maybe 1 minute. There's a nice instructional video from my colleague Bruce Pringle from Bookmap, which shows you how to add columns, custom columns into Bookmap, as well as SpotGamma levels or every other levels you want to have It's really straightforward, this kind of adding brand service to Bookmap. He's providing an URL, and you can add it very simply to the Cloud Notes. Cloud Notes here, it opens a configure Cloud Notes panel. You add simply the URL, which is given to you by Brent, and that's it. So then lean back and enjoy the levels and understand. You will understand and see more than maybe the normal candle chart trader. Okay, good. Finally, I would like to give you some information. This video, as Brent said, will be published on several channels. You can replay it again if you want, and if you need. You can get a lot of trials. You can get, of course, SpotGamma trials for Bookmap, SpotGamma not for Bookmap. You will find every information on SpotGamma.com. I'm writing a lot of articles, posts, and on my page TTWTrader.com. If you are interested in Bookmap Education, please go to TTWTrader.com and go into the shop. You will see there the education, the online video education, as well as the Bookmap TTW Market Volume Pro indicator. And if you are interested to see how stop runs are working, how market directions is indicated, how divergences are built in the market real time, non-smoothed, not aggregated or whatever, real time, really, I'm talking about real time, then have a look at marketplace.bookmap.com for additional products there. So that was it from my side, and thank you very much for your interest. Stay safe at this
Thank
days.
you, Walter.
So
Wash your hands.
yes, wash your hands, social distancing, clean surfaces. That's really important. I think all over the world, not only in the US, not only in Europe, but all over the world. Let's see whether we have some questions.
We have some questions about the level, the white line. If you could bring up the screen, if you don't mind, of where you have the level displayed in Bookmap there.
This one?
So Nate and Andrew asked, the white line is the open interest level, and we say it's linked to 2850. So the so the white line is just Walter draws that line to help him remind him where the SpotGamma level is. So the SPX open interest in this case is 2950. That is where all the open interest is. I adjust that to 2944 because the futures trade at roughly right now a 6-point discount to the S&P, to the SPX index. And so the thing about the options expiring worthless around this level, right, is that this is the aggregate of all expirations. So most of the open interest is on the monthly options, which is the third. They expire the third Friday of every month. So the weekly options are the ones that are expiring Monday, Wednesday, Friday of the week. Those typically don't have that much size, but if they're big enough, you will see on an intraday basis that the market may move to that level, right? But in general, to say that the market maker is going to try to pin 2950 that would be an exercise in futility, right? Because that expiration, those contracts may not expire till, let's say, June. So the reason that I think 2950 will come up is because I believe that there's just sort of levels that the market makers are going to need to hedge, and I believe they'll set out, okay, if the market moves up to the 2950 level, that means our risk goes up by X%, so let's sell futures there. That is the kind of activity, simplified method of sort of explaining what I think is happening there. So, you know, there's the pin idea, which I think can play out when there's a large when there's a large expiration. But you also have to be cognizant again of where is all the volume taking place in the options for today, right? If all the options, as I mentioned before, we're trading today at 2950, we may well have seen the market make a better attempt to hold 2950 today as opposed to sort of sell off. So everything is kind of a cycle, right? There's the day cycle and what volume is taking place today, not just from market makers. I mean, you can't explain all movement simply by options market makers, dealers, right? But there's also this monthly cycle. Where's the big open interest, for the month, for all the months combined, and then also where's the activity for today? So I hope that answers the question about the white marks on the chart.
Yeah, just let me add what I'm doing every day. So I'm posting my levels in the tweets and Twitter, excuse me, and my trading room here. And simply for myself, I'm drawing a white line. You can also, by the way, you can also use the alerts. It's quite simple. Let me show you that here. So if you convert the cloud nodes, which is which we need because we want to have this data dynamically added to the cloud nodes here into Bookmap. When you simply switch off or switch to custom nodes, then you get this label too. But then now you can, when you click on this label, you can add notifications like alerts, or you can add your own sound files to these levels too. So if you do that, just let me.
And while you're setting that up, one thing to mention: the notes that I put out in the email and on the website, those are just the SPX level. The only adjustment that I currently make for futures is for this Cloud Notes application because I know people are trading futures using these notes. So if I send an email, my morning or night email that says 2850, that's not a futures adjusted number, obviously.
Okay, great. Just to complete that, so if you want, when you receive once before the open Brent's levels, you can also switch very easily the nodes from cloud nodes to custom nodes, as you can see on my screen here. And then you can click on the label. You see here's node C2945, add notifications, and then when the price hits this level 2944, for example, then you get a sound. Why I'm not doing that is, first of all, it's a little bit disturbing all the time when the price is hovering for 10 minutes around this price level 29 for 44. Yes, it's simply disturbing because it sounds too much. Too many times around this level, so I'm not using that, but it's simply possible if you want to be prepared for the day to give an alert to this zero gamma level, or what level you have or you want, or yes, Brent is providing. So, and you must think about that, you must think about to switch back, because for the next day you will have then the you will have the wrong links then, or you want to get the cloud nodes then into your bookmap. That's all what I wanted to add to this question.
Great. One thing too, that this is recorded, this presentation, and so we will be sending it out to everybody. That was one of the questions here.
Yes.
Okay, so we have a few questions about the SG index and the idea of how that may work. So I'm going to show a quick slide there on that, if I can. I'm going to take over the screen share real quick, Walter.
Yeah.
Hopefully that won't break anything. Okay. Walter, can you see this chart?
Yes, I see that.
Okay, great. So what we're looking at here is so we call this the SG index, which is just a proprietary calculation of gamma. It's similar to notional gamma, the GEX as everyone calls it, but I made a few tweaks that I think were important and show some very promising results. So when I talk about the one-day forward return, what we're doing is we're plotting, this is the daily GEX from 2018, or the daily SG index, excuse me, with that given return for that day. And so you can see as the gamma index moves lower, more negative, that forecasts a much larger, wider price distribution, right? So today we had a positive 0.5 or 0.6 gamma index, and that you could see that when we have that 0.6 index, those days are typically not very high volatility, right? The one-day returns are all packed pretty tight, and the more positive that number gets, the more positive the SG index gets, the tighter the returns, right? The more gamma there is, the lower the volatility is. And then you can see that there's this sort of sweet spot around -1 where there's a very large amount of very wide dispersion in movement. So yesterday we had a -1 return, or excuse me, -1 SG index, which implies a much wider distribution. If you do the math on that, it's about a 2.5%. One standard deviation moves 2.5% in the index. So that implied that we would have a very volatile day yesterday. And then today is a positive 0.5 SG index, which implies just a 0.9 one standard deviation return. So this is the information that I'm using to say this is how you can project what type of day it's going to be, right? If you know going into yesterday that that we're forecasting a very high volatility return, and the first level that is of importance is 2950, and we're only at 2875, well, there's a decent chance that we may make a run at that level. That may be where you decide to put your stops. That may be decide where you want to try to short the market, right? And so using this price distribution can factor into your trading plan along with whatever else you may consider. It may help you decide which levels you really want to play. You know, do I want to leave a runner on if we break 2900 and then keep that to 2950? All these different kinds of things. So I hope that helps to explain that level a little bit. There's not an upgrade path for the Bookmap. It's simply a Cloud Notes CSV link I send you that can be imported. James says Amuda options. He's been using Bookmap for a while. Yes, there's plenty of resources. We can talk about Gamma. There's things on the websites. There's a couple of videos on our YouTube channel I can send you that you can watch that give a very kind of in-depth presentation on the nuts and bolts of Gamma, and I'm obviously happy to answer any questions around that. So Nate asked if we could see an example of what the 3 triggers look like preceding a large bull move. I'm not entirely sure what that may mean. I don't know if that was for yesterday. I do keep a history, Nate, of our move. So if you want to email me, that's info@spotgamma.com. I can touch base with you on that. The daily mails are not adjustable for futures, only the SPX level. That's correct. So I only send out the SPX level Bookmap because I know it's futures traders. I will do the adjustment. So once you subscribe to SpotGamma and/or Trade to Win, we send you a login, and then you also are automatically subscribed to get the daily emails. A couple questions around what products. So I only do the ES SPX complex right now, and that is because the options market is such a has so much volume related to the volume in the underlying, and so that is why I focus on the S&P. The Nasdaq does not have as much options volume, although I think that is beginning to change, and so that is something that I'm looking at. In the S&P, we'll have 5 or 6 levels every day that we can watch. I think in the Nasdaq, we'd probably end up maybe with 1 or 2, and the same goes for crude and gold and some of these other products that I think we can look at and find. Okay, there's 1 or 2 very important levels, but there's not going to be as many as say 4 or 5 levels that I think matter, because at the end of the day, it is about open interest and gamma relative to the underlying volume. And that open interest and hedging activity needs to be large enough relative to the underlying volume to have an impact.
Yeah, absolutely.
How do we use the information to GEX level expire on OPEX days? So OPEX is an interesting point. Thank you, Anjan, for bringing this up. OPEX is interesting from a delta perspective more than a gamma perspective. And what I mean by that is that we know on OPEX there's going to be a lot of contracts that expire and/or are rolled. And so a gamma trade is an adjustment to the deltas that you have on, but when the contracts expire, what ends up happening is it leaves you with either you have way too many deltas, long or short, right? Because you had a whole bunch of contracts that expired that were hedged, and so when all those contracts expire, then you have a bunch of hedges that you no longer need, and that is why I often think OPEX can be such a turning point. If you look at the May OPEX, which was Friday, there was a lot of mainly puts that were in the money that expired, and so you could surmise that dealers had a lot of deltas to buy back. They were probably short futures against a lot of puts that expired, and so when those expire, that means deltas to buy back, and I think that could have been what fueled sort of that move yesterday. And so on OPEX, I tend to focus less on gamma and more on delta, if that makes sense, Anjan. I hope that helps. So the put wall, just to focus again, put wall is not just where the most puts are, it's where the most negative gamma is. The high gamma strike is where the most call gamma is, and the put wall is where the most negative gamma is. And again, we want to weight the open interest by gamma because it tells you, it puts some meat on the bone, so to speak. It weights the contracts, and that's what we're really doing with the put wall and call wall. If hopefully that answers Peter's question. Sorry, everybody, I keep screwing up the distribution chart. I will practice. I'll practice the webinar software for the next one. Another example apart from today, Nate. We have several examples I can send you. I have screenshots. If you look at Walter's Twitter, as you mentioned before, he posts a whole bunch of levels almost every day with the gamma levels and ranges to look at. Treasury futures is another interesting market I do intend to look at. David, what time on Friday do I think market makers start running deltas? So I spoke to a market maker who told me that generally what he does is that, or what he believes happens with other firms, is that in the morning they're typically short gamma, right? Because there's a whole bunch of things expiring at 9 a.m. or 9:30 a.m. and they'll offset that gamma risk with the PM contract. So as you know, there's two expirations on the third Friday of every month. There's the AM contract, which is the bigger one that expires, and then there's the PM contract. And so I believe that a lot of times those deltas will get adjusted kind of into the close on Friday, but on Monday, you'll typically see a lot of the movement. For instance, in March, after that really big expiration in March, it was the Monday after OPEX that we saw the high of the day, the low of the market. And there was just a very sharp turn in markets higher right after OPEX on the Monday after it started. And similarly in February, we started to sell off on the Friday of OPEX, February 24th, I believe it was, but Monday was really the kind of overnight over the weekend, and then there was a really big gap down on Monday. The different types of trades for positive gamma and negative gamma. It's a good question, John. Negative gamma is telling you that there's directional trading. You should be positioning directionally and not trying for mean reversion. So yesterday was a great example. We started the morning in a negative gamma position, and even at 29.50, it's just a very low positive gamma level. But basically, on negative gamma days, you want to position for directional movement. So as Walter mentioned before, 29.50 today was kind of resistance. You want to short 29.50 and play a longer directional trade in a negative gamma environment, right? So short at 29.50 and then don't cover until the next significant level. If it was a mean reverting type market, a high positive gamma market, you may want to try to buy 29.40, anticipating the market rally back up to 29.50. So when we talk about mean reversion, that's kind of what we're getting at, is that you want to pick an important level and then buy the dip and sell the rip around that sort of key level. That's what we like to do in a high positive gamma environment. And so in a negative gamma environment, again, the levels are still important, but you want to play more directional swing trading, as Walter mentioned, between sort of larger levels. Nate asked about the volatility trigger. So this is kind of an interesting point. And for those of you who are into technical analysis, you'll understand moving averages and the like, where there's not really a fundamental reason why a moving average the market should bounce at a moving average, and Walter could probably appreciate that. But everybody pays attention to the moving average, and so that's why it's important, right? And the zero gamma level is a very interesting similar concept, because at zero gamma, technically there shouldn't be any trading, right? Zero gamma is telling you that that market makers don't have any hedging. They have no axe to grind at zero gamma, right? And so when I was originally building this concept, I built the volatility trigger as the level that actually mattered. But what I found was, in my brief presentation there, you could see instances where the market seems to react to the zero gamma level. My only real feeling is that, well, people pay attention to zero gamma, and that is why the market moves around that level. The volatility trigger was my original mark of where the market should transition between a positive gamma environment and a negative gamma environment. And so I build an algo. I have an algo that essentially stress tests the market and finds out where sort of the last pocket of futures liquidity should appear, that serves as a function, as almost like a gate between positive gamma and negative gamma, if that makes sense. So in my model, volatility trigger is the real entryway or point at where gamma should go from positive to negative. But I started to include the zero gamma level because I just saw the market would react uncannily to that level as well. So that is why those two levels should rhyme and mimic. But in my real longer-term model, I pay more attention to the volatility trigger as whether we're in positive or negative gamma territory. On a day trading basis, I'll watch the zero gamma level as a trading level, sort of like a moving average. A question about call put delta skew. In the model, I really just sort of keep calls positioned as dealers are long calls and short puts, and so from that perspective, there's a skew there. Because that's what the sort of a model assumes, and I hope that answers your question, Shashank. And how are we accounting for the deep in the money call? That's a very good question. So one of the things that I thought actually really moved the market in March was very deep in the money puts, and those produce a lot of very high, very large amounts of deltas for dealers to hedge. So if you imagine that what was the velocity of March was a whole bunch of deep in the money puts, created massive amounts of futures that need to be bought and sold on every basic movement up and down in March, right? Because these dealers had to keep constantly adjusting for these very deep in the money calls, deep in the money puts. And so, those deep in the money calls figure in on a delta basis in a major way into the model, but not so much on a gamma basis. It figures in on a gamma notional basis because obviously if the market moves higher, well, there's some trade adjustments that need to be made, from a dealer's perspective. And so on a day-to-day basis, if you watch the gamma number, the notional gamma number, those deep in the money calls will be sort of incorporated in there. But more important are, what the large gamma strikes are in terms of where I'm looking on a day-to-day basis. Where the deep in the money calls really come into play and where they really factor in again is on the expiration, because again, when those deep in the money calls go away, that creates a delta gap, a hedge sort of underhedged, overhedged adjustment, so to speak, on money. Like we just had this on Friday. So to answer that question again and be more succinct, the deep in the money calls, deep in the money puts, I pay more attention to those on a OPEX situation. However, we do monitor total delta in the market. And so if there's a deep in the money call, that tells us, okay, deltas are really high right now, and that will indicate maybe more hedging activity or more flow on a daily basis. Zero gamma and zero gamma and neutral gamma are the same thing as right. Kyle says if we're positioning an SPX vertical spread, would I use the zero gamma or the volatility trigger as my short? Generally, those contracts should be in the same neck of the woods. There should be maybe 10 strikes between them. So depending on how far on time you're going, I would just pick maybe the mid between those two levels. If you're trying to trade off, say, today or tomorrow, I would have more confidence in the volatility trigger functioning as support and resistance than I would the zero gamma level if I was day trading. I hope that answers your question, Kyle. Did I get everything here? I hope so. Walter, I know it's late for you there.
Sorry?
I hope I got all the questions, making sure there's nothing else here. I know it's late for you there.
Okay.
So again, I'll send out the dispersion chart to everybody who is on the list today. This is the scatter plot of how we calculate the gamma index. And I think we're all set. So I want to thank everybody very much for their time. I know we spent a lot of time here going through all of these different levels. If anyone has any questions for Walter or myself, we'll send out a replay recording, the scatter plot, and then as well as links to Walter's fantastic services, a link to his Twitter account where he posts, just tons of content and tons of information about how he's trading. And then, as always, you guys have my email, info@spotgamma.com. And so we appreciate your time. We'll let Walter go to bed because I think it's like 2 in the morning there or something. Poor guy.
No, it's not so late. But anyway, thank you very much, Brent. Thank you very much to being your guest here. And if there are any questions around Bookmap, and what I can do here is showing I'm placing every day, or when I'm around, when I'm not on holiday or whatever vacations, I'm posting my levels, which comes together with the SpotGamma levels every day on Twitter. You can follow me there. You can comment that if you want. So I saw a question which was to post a random chart for how this zero gamma is working random day. I'm posting that every day. You will see tons of pics, of screenshots there on Twitter. So don't hesitate to ask me or Brent if something is not clear about that. So that's all what I wanted to say. I'm open for every question. Contact me or Brent. We will come back to you as soon as possible. Thank you.
Great. Thank you, guys. Everyone have a good night, and we'll talk to you all soon.
Thank you. Bye-bye.